Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of financial filings to find the juicy secrets hidden within these official documents. Get ready because today we are diving into Deluxe Corporation's latest report. And let's just say this one involves a bit of financing juggling that could have some ripple effects. Before we dive in, make sure you hit that subscribe button if you love getting these kinds of insights straight from the source. And if you want to connect with other finance enthusiasts, join our Discord community linked in the description below. Alright, so what we have here is a Form 8K filing. Think of this as a way for companies to tell the public about big important things that are happening right now. It is not a regular update like a quarterly report, but more for major events. And the company we're looking at is Deluxe Corporation. They are a well-established player and they've been around for a while, typically providing services like business checks, marketing solutions, and payment processing. The main story in this filing revolves around an amendment to something called a receivables financing agreement. Now, that sounds complicated, but at its heart, it is a way for Deluxe to get cash by using the money that its customers owe it. Imagine if you have a lot of invoices out there to your clients. You can essentially use those future payments as collateral to borrow money today. Specifically, this agreement is between Deluxe Receivables LLC, which is a special part of Deluxe Corporation designed just for this kind of financing, and some big banks with Mufji Bank Limited acting as the main agent. So what has changed with this amendment? The most significant part is that they've increased the amount they can borrow under this agreement, which they call the facility limit, from whatever it was before up to a whopping $100 million. This means they've got access to a lot more readily available cash. Another key change is that they've extended the deadline for this agreement. It was supposed to end in March of 2027, but now it is pushed out to December of 2028. This gives them more time to use this financing tool. It suggests they might need that access to capital for a longer period, or they simply want the flexibility. Now, how much this borrowing costs them depends on their credit rating. They've updated the fee structure based on their long-term debt rating. The chart details different pricing levels. Right now, they're at pricing level 2. This means their borrowing costs are tied to how good their credit is, and they are in a middle tier. Not the absolute best, but not the worst either. This is pretty standard for many companies managing their debt. Essentially, this means they'll pay a certain percentage on the money they borrow, and that percentage can go up or down depending on how well they are doing financially and how credit agencies view their ability to repay. This amendment also means they've officially created, or in this case modified, a direct financial obligation. This is just formal language saying they've agreed to take on this debt or credit line under new terms. For all the legal eagles out there, the full details of this amendment are available as Exhibit 10.1 to this report. It is the nitty-gritty legal document that lays out everything precisely. So, what is the big picture here? Deluxe Corporation is essentially beefing up its short-term financing capabilities. Increasing the facility limit to $100 million and extending the termination date suggests a strategic move to ensure they have ample liquidity. This could be for various reasons: funding new initiatives, managing working capital as their business grows, or even preparing for potential acquisitions or economic uncertainties. From a Warren Buffett perspective, we want to see if this increased access to capital is being used wisely. Is it fueling profitable growth, or is it merely a way to paper over existing financial strains? The fact that they've extended the agreement and increased the limit is often a sign of confidence in their ability to service the debt. But it also means a larger potential liability if things go south. The pricing level being TWE indicates they are in a stable, but not top-tier, credit position. This isn't necessarily bad, but it means they are paying a bit more for their borrowing than a company with a stellar credit rating. In terms of company direction, this move signals a proactive approach to financial management. They are ensuring they have the funds available to operate and potentially expand. The risks here would be if the underlying receivables they are financing don't perform as expected, or if interest rates rise significantly, making this debt more expensive. On the opportunity side, this provides them with the financial flexibility to seize market opportunities as they arise. Overall, Deluxe Corporation seems to be managing its financial structure well by securing a substantial line of credit for a longer period. It shows they are thinking ahead about their liquidity needs. However, as always, the real test will be how they deploy this capital and what returns they generate from it. Alright, that is our breakdown of Deluxe Corporation's latest filing. What is your take on these financing moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.